he was actually I just remembered this when I was coming up. He was actually the first ever guest on Words of Wisdom, right? The first ever guest. I've known him for 5 years. He has grown massively in that time. He's always had one of the most professional mindsets I've ever seen. He writes articles on fundamentals, right? Fundamental research. Citibank, listen to him. BlackRock, listen to him. And I'm pleasured to announce that we have Joe Olashugba joining us on stage right now.
Yes, no? Can you hear me clearly? Cool, perfect. Do me a favor, turn to your neighbor, welcome them, tell them they look nice, give them a handshake. Couple people are tired, yeah? So let's do that briefly. You look good, guys, right? Turn to your neighbor, welcome them. Clicker should be here. Perfect. So a bit about myself. We're going to be simplifying global macro. Like Riz said, I've been fortunate to know Riz for quite a while, 5 years now. And myself, I started, it's not articles, it's investment research. So you said articles, but it's fine. Investment research. So I run Market Macro Hub myself. I've got 2 analysts with myself as well. And like I said, fortunately, I've got now friends who are, rate traders at JP Morgan, PMs, PM at Amundi, PM at Allianz, you name it, Citibank, Bank of New York, so BNY Mellon. So I mean, the whole street, luckily are fortunate to read the research I write, and it's a combination. I don't just write, investment research. Sometimes I might do global macro lessons. So I might talk about currencies and why currencies are important for global macro. They're a fundamental layer for markets, simply put. So everyone here mainly trades FX, right? By show of hands? Cool, good. Now what you notice is that for me, I started on FX, but I've kind of broadened my horizon. I don't do funded accounts. It's not my kind of niche, but it's something I do understand very well. But for a lot of you here, you probably just focus on technicals, understandable. But I want to open your mind to global macro and hopefully inspire someone, hopefully give someone a bit of a reason to go deeper into it. Every single person here most likely goes on investing.com or trading economics just to look at the fundamental weekly outlook. And for the most part, unfortunately, you'll probably see the red calendars and all you'll say is, I'm not going to trade that, all right? Or you'll probably say, I'm going to skip that. Or you know what, NFPs this weekend, 10 lots up, 10 lots down. It's not the way to go, right? So I hopefully want to give you a bit of education on how you can actually understand macro, because the truth is, it's what moves markets, right? When you get to the bigger playing fields, when you enter different rooms, you understand that this is what everyone's actually watching. This is what everyone's reacting to. I've done a primer on treasury auctions, something which many people don't understand, a primer on currencies. So let's go into it and I'll hopefully give you a bit more insight into what we're going to talk about. So let's make it simple. If you're taking notes, 90% of moves in FX are simply driven by interest rate differentials. That's it. Interest rates drive currencies. As simple as that. So what you're looking at is a snapshot from the beautiful Bloomberg terminal. And as you can see, we have the best spot returns and we have the worst spot returns as a percentage. Now you can see the range is from, let's use a laser, from the end of 2023 just to mid-June, right? And you can see the best spot return has been the Russian ruble. And I'll explain why you have, these currencies here at the bottom. But for the past 3 going 4 years, the best trade has been dollar yen, right? Everyone has seen that massive move. Every single person has. Many of you have been those people saying, you know what, it's going to reverse now. It's going to reverse now. And I'm sure many of you, unfortunately, have caught the wrong end of that. Going short, trading against the Bank of Japan, it's not going to work in your favor. So I'm going to explain to you why. You see, when you look at a currency, the main thing that makes up a currency is interest rates, right? Why? Because if I'm an investor and I live in the UK and I want to borrow cheap, where do I go to? I'm not going to borrow here. Rates are 5.25%. So I might go to Japan, where rates are now only 0%. Okay? Now, let me make this make sense. So, I'm an investor. I want to, let's say, do a private equity deal in UK. I want to borrow cheap. I want to borrow anywhere. I go to Japan. I can borrow money for literally nothing. And I can invest it, let's say I want to invest it domestically here in the UK, and I can earn a yield of 5.25%. Does that begin to make sense why you would do that, right? You want to borrow cheap. It's like, for example, if your bad friend You might borrow money from your friend. He doesn't want to charge you, but you lend it to someone else and you're charging him. You could do that. That's what we're doing in our markets, okay? So when you're looking at currencies, the first thing you want to do, if you want to make life simple for yourself, is say, okay, if I know currencies are driven by interest rate differentials, when I'm looking at the economic calendar, clearly my only focus should be what? What's going to affect interest rate expectations. That's all it is. That's all it is. So you have one, the current level of interest rates, and two, what will affect interest rates. At the start of, the end of December 2023, the market had priced in there will be 7 interest rate cuts by the Fed. Now it's gone down to 2, right? So if you're wondering why has the dollar caught a bid, that's a technical term for why has the dollar been bullish since now January to July, that's why. Because the market has now repriced and taken away 7 interest rate cuts all the way down to now 2, potentially 1 in September and potentially 1 in November, December, okay? So that's all it is. Oh, it's getting in the way. So when you're looking at anything to do with a week of economic calendars, the main thing you want to focus on, we'll go to the next one. To be fair, we'll go here. We'll stay here for a minute. But when you're looking at your economic calendar week, you want to focus on things like CPI, okay? Why? Consumer price inflation. When you're looking at a central bank, let's take the Bank of England, their main mandate is what? Stable prices, okay? Stable prices. Now, apart from that, it's to govern what? Employment, ensure it's maximum employment, ensure that what else is stable? The economy, okay? So anything you're doing in your week, if you're trading anything, euro dollar, I know many of you might trade euro dollar, cable, you might trade maybe dollar yen, anything you're trading, the main thing you want to ask yourself is, how will this affect rates, okay? If inflation comes out hot, and you can actually go home and backtest this, right? If you look at the most recent, let's say the past 6 months of US inflation, it usually comes out on the 12th or the 13th of every single calendar month. So usually a Tuesday or a Wednesday, CPI. Now, if you backtest, if inflation came out above expectations, the dollar caught a bid, meaning the dollar rallied. Why? Because the market says this, okay, inflation has come out hot, which most likely means the Federal Reserve will have to, 1, hold rates, or 2, hike rates. Simply meaning they're going to be hawkish, right? So you have 2 terms. Whenever you're looking at a FOMC press conference, ECB press conference, Bank of England press conference, you have hawkish and dovish. It's a tonality, how they're talking. Are they confident about the economy? Are they aggressive? Are they talking about potential rate cuts? Or are they dovish, right? The most dovish central bank year to date has been the SNB, the Swiss National Bank. They've cut rates twice already. I believe the first major central bank to do so, okay? Now, let's go through this. LATAM FX. Now, it says LATAM FX was the best performing currency since COVID 2021 until April 2024. Why? Simple. They raised interest rates 12 months before anyone else did. So, keep an eye on CPI, PCE. For the Fed prefer to use the personal consumption expenditure as a better gauge of inflation, right? You don't need to know everything. Let's make it simple. All you need to think is one thing. How does this potentially affect rates? Will this make the central bank, the Bank of England, Bank of Japan, the Fed, hawkish at the next meeting, which means a bullish dollar, a bullish currency, or will they be dovish? That's it. So when you're looking at your calendar and you're saying, oh, manufacturing ISM is coming out, I mean, it matters, yeah, but not really. Yes, if you have a massive surprise and, ISM or PMI, you might see some movement in maybe yields, but for the most part, it's not going to really drive the currency, okay? Now, you do have certain things which may move markets. Of recent, we've had elections. How many of you voted by show of hands? No one's got hope in the government. Good. All right. I don't blame you. So Labour won. Now, luckily in the UK, markets are pretty stable. Rewind to Brexit, markets weren't. But if we look globally, unfortunately or fortunately, I have to do this. I have to watch majority of elections. You can see we have the what is the Mexican peso? So this was prior to June. Now, in Mexico, they had their presidential run, and you've actually, if you go and look at the Mexican peso against the dollar, you'll see it dropped north of 7-8%. That was due to politics, right? So political elections usually instill volatility. Now, hopefully this doesn't get too technical, but the trade world is talking about, right? When you're going long a high interest rate currency against a low interest rate currency, that's called a carry trade, because you're carrying a trade. Earlier this year, myself, I was short the Chinese yuan, the CNH. You have the CNY, which is the onshore, CNH is offshore. You can't trade the CNY, no liquidity, dead, but you can trade the offshore, which is the CNH. That was a very simple trade. Minimal technicals needed because you're doing the simple. Rates in America are 5.5%. The 5-year LPR rate in China is 3.45%. Maybe if you're looking at the 1-year LPR rate, it might be a bit lower. Simple. The rate differential makes the trade simple. Now the beauty is, unfortunately for many of us here, if you're holding trades overnight, you're paying a rollover fee, you're paying overnight charges. Annoying, right? You have a good trade and you look at the P&L, it's like, hold on, why have I lost so much? Because you're usually, I'm guessing, negative carry for the most part. Now what that means is that you're having to pay the cost of borrowing overnight. Now when you're in a trade, like a carry trade, and you are long the dollar against the Japanese yen, the Chinese yuan, you're getting paid to be in the trade. Because when they calculate the differential in rates between the Chinese yuan, the dollar, you're positive carry, okay? So these are terms you want to go home and search up because it makes life simple. Imagine you said, and we'll go to it, imagine you said, we have 4 case studies. This was the position, I believe I was long somewhere around here. I'll be honest with you. Can't remember the exact price point. But imagine you said to yourself, I'm going to hold this trade for the full year. This is January 2023. This is January, round about here, it's 2024. This is January 2024. You can see this is simply just a one-directional trade. So when you're trying to understand why is the market trending like this, why is the market moving like this, you need to understand what's happening on a macro perspective. It's not enough to say, I just know technicals. For some people, it might be, but I recommend, once again, if you do want to take this game to the next level and talk in the institutional field, you might want to learn macro. It's not a must. I know many people who don't, but I would recommend if you do want to, again, push yourself. And plus, when you learn macro, it just makes you a well-rounded market participant. You don't need to say, all I'm going to do is trade fundamentals. No. But if you have an understanding, I promise you will help you, okay? That's one example. Another example, so this is what we're talking about, political volatility. So here's a bit of a proxy you can use. Whenever there's volatility in markets, in currencies, you want to be short high beta currencies. Now, beta is simply a term used to quote high volatility. So high beta assets are equities, crypto, simply put, high risk assets, okay? High beta equals high risk assets. Make sense to everyone? Good. Now, in periods of high volatility, what's the trade? Safe havens, right? The yen, the Swiss franc. You following everyone? Yes? Cool. So in periods of heightened volatility, you have people go to the Swiss franc, to the Japanese yen. That's what they do. Now, what does that mean? If they go into these currencies, it means they're getting out of what? High beta assets, high beta currencies, okay? The Mexican peso is a high beta currency because it's a very volatile currency. It's an emerging market currency, an EM currency, okay? So you can see this was the elections when it was announced, and you can see that drop was pretty drastic. So although you might say, yes, a carry trade is perfect, you have to watch out for certain events. If you trade purely technical, when you were trading the Mexican peso against the yen, you would have been slaughtered, most likely slipped on one of these candles because you lack the understanding. And it's something which is cheap.
Would you pair that up as a pairs trade? Would you go and maybe be long gold and short the high beta currency?
Good question. Good question. Would I go long Mexican peso, Japanese yen, and short gold, or the other way around, I'm guessing, right? You could. I personally wouldn't. No. I personally wouldn't. But it's something you could definitely do. Because one's, once again, low beta, pretty safe haven. Other one is high beta. But that's a perfect example where you're kind of pairing two opposites. Go long gold, go short, which is actually very good. It's a good position. So yeah, take note of that, guys. I'd recommend that. So where can you stay clued up? Now, I'm going to give you a ton of resources, all of them free, which you can actually use to start learning about macro, all of this thing, because I know for many it might sound like jargon, but I promise you, if you just start small, day by day, learning, it makes a lot of sense. And I'll tell you a bit about myself because I kind of skipped it, but I didn't go to university. I didn't finish A-levels. My dad doesn't work in finance. My mom doesn't work in finance. She works a blue-collar job. So I've never had that background where I could say, oh, I know this stuff because I went to Cambridge or Oxford. No. I dropped out at sixth form when I was 17. Unfortunately, at the time, my dad fell into a coma, had a stroke. I was 17. We couldn't pay bills at home. So it was either do or die. So I had an adult decision at a young age, and I said, cool, I'm going to leave school, I'm going to go work. I'm going to find a job, and I went to an office in Mayfair, and I said, look, I'll work for free, just get me in the doors. I can prove myself. Thank God they did, and the rest is history. So there's no excuse to say you can't learn, you're not smart enough. The people you think are the smartest, people who are now friends at BlackRock, at JPM, they're no smarter. All they do is just a bit more work. On the Saturdays, on the weekends, when everyone winds down, they wind up. Yesterday night, same thing. I wanted to relax. I was like, let's do a bit of work, because I understand what it takes. So when it comes to macro, the same way I know everyone here works hard. When it comes to technicals, I'm sure you do. I'm sure you backtest, I'm sure you do all the work. So I recommend put the same effort into macro. It can do so much more. Open many more doors as well. So I'll come back to this at the end, but I'll say when you're starting out, XTB, right? Simple broker notes every morning, you can read that. They have a daily snapshot. So if you wake up early, 6 a.m., 6:40, they'll post a daily note, and all that is, simply put, is what is happening today, and your job is how can this affect my day in trading. There's no math, there's no nothing, it's simply put what is happening today, can it affect me, is it a risk? That's it. XTB is one. Market Macro Hub, of course, this is my own research. A lot of things there here are free. To be fair, a lot of things I put out there are free. A lot of the more, I say, investment research, that's what's paid for, but you don't need that. So whatever's free, take it. I always say that. Harkster is another great platform for beginners. When you're starting out, it's like a news terminal. You can use that, take it down, absorb it. There's a lot of chatter here. I'm sure you can see. Not everything is signal, okay? Now when I say signal in markets, I'm sure you know, you have noise and you have signal, okay? So it's your job to differentiate between the two. Because like I said, I could be up here talking about PMIs, talking about housing sales, but that doesn't really move markets, okay? So it's important to know what moves markets. And I'll come back to that as well. Another point came to my head. Blockwork Macro. So honestly, I love these guys. There's a lot of talk about markets broader than FX. This is something you can listen to in the gym, something you can listen to on the train, on your daily commute to work. Just because the thing is, when you keep your mind in the realm of financial markets, you pick up on stuff, right? When I first entered the world of FX, I thought all I would focus on is FX. But now I've come to a place where honestly, I'd say fixed income more than I love FX. I was trading JGBs, which is Japanese government bonds, early this year, and I've been writing a ton of reports on why JGBs are still shortable, which is fixed income in Japan. I believe the fair value of the yield is still quite a far while away. A lot of the clients I have reading it are in that position, which is good. So, I love global markets. I love fixed income. I love Asian markets more than European markets. There's a lot more volatility, a lot more fun, a lot more unpredictability. I'm sure everyone here, if you know the Bank of Japan, you know you do not play with them, right? They can mess you up quite quickly. So, yeah, the truth about learning macro is yes, at first it seems unprofitable, and that's why no one learns it. The first thing you done when you entered markets and trading was go to a technical chart. It wasn't read about risk on, risk off, high beta, low beta. Let's be honest. I myself are the same. Now, it seems unimportant and necessary, but as you study macro, you realize the large importance it plays in dictating larger macro plays. I'm not sure if anyone here is invested in equities, but the beautiful thing is, when you learn about macro, you can actually switch out to equities. And you can do something simple where, I know Japanese equities have been ripping it, performing really well year to date, even last year as well, towards the back end of last year. You could easily go long a sterling hedged Japanese equities basket. It might sound like craziness, but just research it and you'll see the returns. It's healthy. Because you know that, hold on, if the currency in Japan is weak and the currency in the UK is strong, if I go long a basket of Japanese equities and I hedge that trade, I hedge that position using sterling, that's a winner. You're pretty much profiting from the rate differential, well, from the currencies. We'll come to questions that, go ahead.
Would that be a simple case of whatever monetary amount of your long of the Japanese stocks,
Yeah.
then you simply just hedge that up against the...
Good question. So with hedging, you don't have to do the hedging yourself. You could literally go and buy an actual naturally hedged position on Fidelity, on HL. They're available. So if you search sterling hedged Japanese equity basket, you'll find a ton. So you can get it there. So this is the truth about learning macro. So I promise you guys, it's fun. When you get into it, you can't stop learning. And the beautiful thing is it opens, once again, so many doors, so many more conversation points you can have. Because when you meet people who are industry professionals, I was at a conference last month. Apollo was there, large PE firm, Exodus Capital were there. So you have many firms, and the truth is you can't go to them and say, I caught 30 pips on euro dollar. They'll look at you and say, okay, cool, nice. You can't. Yeah, I'm long gold, 60 pips up. No, it's just not going to happen, right? They like to talk about ideas, right? So for many of you here, this is the start of your journey. For some of you here, you are at the heights of your journey. But I'm sure you're thinking, hold on, what's the long-term game? For myself, Riz knows me very well. As soon as I entered the game, I had my eyes on the long-term game. And by the grace of God, it will come to pass. And I've kept my eyes. It's a long-term play, long-term plan, but I'm sure you'll see the fruition of it. But what I'm saying is macro opens your mind to much more than what you know. It can help you from day one, makes you smarter, makes you everything you want to be. So whilst I've got 7 minutes, let me open up any questions before I wrap this up. Any questions? Cool, we'll go start here and we'll come to you.
Hello, my name is Farry. I'm a big believer of macro, but how long does it realistically take to become expert, or I would say someone advanced like yourself, to learn it?
Cool.
Thank you.
Good question. Hard question, because I look at myself and I say I'm a rookie in my eyes, because I know the game is so deep. It's extensive. I've been doing this now. I started Market Macro Hub in 2021, so 3 years. When I first started, honestly, I had 4 subscribers. All 4 were family friends. So we didn't have no one, and I taught myself everything. So I'd say, invest 1, 2, 3 years, but you might be quicker, because my journey was my journey because I didn't have anyone I could kind of bounce off. No one around me was doing macro. It wasn't popular. But your journey is your own journey, so I'm sure you can take maybe 1, 2, you might do it in 6 months, who knows. But no one ever reaches expert level, and even if you do, you feel like there's more to come. Oh, man. No worries.
Hey,
Cool.
I'll bring it over, yeah.
No worries.
So, we spoke about currency pairs, but for the people here who do trade indices, equities, we'd love your perspective on how you can sort of include macro assessments. So for instance, the NASDAQ right now is, past 20K, all-time highs. This week some of us were holding positions where we were long on it. Data came out yesterday where they said NFP, non-farm payrolls, expected higher, but also unemployment was rising. We do know that they want unemployment to sort of rise so that they can sort of cool off the economy. So it's like two different things that are happening, which are sort of like contradictory to what it would seem like contradictory to what the goals are for the Feds. And, as a day trader who trades technicals and you're looking at that and you're like, should I close out this position? Should I hold it? How would you even try to, approach that,
Good question.
Yeah.
Good question. So unemployment yesterday ticked up to 4.1% versus 4%. NFP came out 206K versus the expected, which was, I believe, higher. So it was a soft NFP print, I believe. But if you're in, NASDAQ, to be fair, all you have to understand is, once again, how does this affect rates? If it's a soft print, cool. The Fed will most likely be dovish at the September meeting. The market's pricing in a 73% chance of them cutting in September, 25 bips, which is 0.25%. NASDAQ is a beautiful indice which loves low interest rates. Tech, tech borrows today and promises tomorrow. So if you understand, okay, cool, the composite is simple, it's interest rates, interest rates, interest rates. You then look at it as, okay, cool, if we have a hot or soft NFP print, that simply means we're going to be X or Y, which is bullish or bearish on the NASDAQ. But for the most part, because of the great performance of your tech firms, NVIDIA, your AI plays, the NASDAQ is kind of defying the laws of gravity right now. And you have the central banks which have taken away, call it the left tail risk, which is simply the possibilities of markets crashing. So I say the NASDAQ is fine. NFP is still showing signs of a cooling labor market, so that will still continue to do well in my perspective. This is not investment advice.
I thought it was broken. No, you're good. Josh stole the mic from me there. I guess he didn't want me to ask it, but that question actually set up for the one I had really well, so that was good timing there. Speaking with U.S. indices and NASDAQ in particular, usually what I trade. But first of all, great presentation. Macro Hub, I'll definitely be checking it out after. You might even explain it on your site. My question here, though, is, we just talked about conflicting with dollar rallying and obviously indices in the U.S. still rallying. Why do we typically see, when Fed pivots, we see the market reverse? But as you said, the market is supposed to react to a dovish approach. When we see the Fed switch to dovish and start cutting interest rates, is that simply the market just creating liquidity for a move down? Because we see people waiting on that move down, waiting for the Fed to pivot. Why do we usually see that? Is that strictly just market creating liquidity and that's why we get that reversal? Or is there a better macro explanation there is my question.
So let me just want to clarify. So when the Fed pivots, we see the NASDAQ move up or down. Is that?
So we've typically just seen whichever way they're pivoting, right? It's a reversal in the market. If the market is bullish, we see a Fed pivot, whether they're raising or decreasing rates. This time it will be decreasing, right?
Cool.
We're expecting a move down. I guess kind of why is that? Because obviously the retail mind is the exact opposite of what we're talking about.
Yeah, cool. So for the past year and a half, the Fed has not pivoted. Actually, December was the first pivot we had, but the NASDAQ rallied hard. So like I said correctly, it's not really the market creating liquidity because it does that naturally. So what it really is, it's, once again, investors have a simple mind. Where's the best place I can put my money which is going to grow? And the beauty is when you're in, for example, the NASDAQ, and you hear the Fed pivot, like they did in December 2023, all that does to the institutional mind is let's go long risk. Because when the Fed pivots, the high beta assets are the best performing ones. So that's all that happens. So Fed pivot equals go long high beta risk. That's what really happens from my perspective. I've got literally time for one more question. I've got a minute. I want to be on time.
Yeah, it's with me here.
Cool, okay, perfect.
Unfortunately, I have 3 questions, if you don't mind.
I've only got time for one. I don't want to take the time out of these guys.
Okay, so let me select most important one. So let's talk about artificial intelligence. You talk about macro. I am learning macros as well, like fundamental analysis. So how does it work, artificial intelligence? What's your experience? If you share your experience with artificial intelligence while working in macro, because artificial intelligence is making a lot of mistakes while processing data. So what challenges, if you tried it, did you have any, did you face any challenges, and how do you cope those challenges while working on artificial intelligence and macros?
Okay.
Thank you.
Okay, cool. I'll do my answer in 20 seconds. AI, I mean, I'm not really huge in AI. It's part of macro. It's going to continue being here. Nothing's going to change realistically. It doesn't really affect macro. It's another sector. It's another part of the market. So for me, there's no real difficulties. I'm just purely playing fixed income, sometimes FX, and I might dabble in a few other things, but there's no real crossover for me with AI. I see it. It's going to be here. It's going to continue being here. It's done well. I know a few people who've done really well from just being long a few AI baskets, equities. So I wish I could talk for more, but I've got 4 seconds. Thank you guys for listening to me.